2023 was a year of surprises. The stickiness of inflation, the significant rise in bond yields across the globe, but especially the resilience of the U.S. consumer that kept the economy growing at above trend for most of the year. We're taking a look at the year ahead and discussing how inflation, fiscal policy, and global unrest may affect markets and continue to shape the economy. 2024 promises to be another interesting year, as it begins with rates higher than we've seen since before the Great Recession, and a world that appears in many ways to be less stable. There are a fair number of extremes circulating in the economy and the markets. For the better part of 15 years, the domestic economy operated within a zero interest rate environment. That environment's gone, and frankly, we would not expect it to return anytime soon, which means that investors and businesses have to adapt to a new normal after years of growing accustomed to zero and near zero rates.
Well, I think there were many lessons that we all learned in going through the pandemic and thinking about just running our lives, households, how businesses are run, the social impacts of that. But the biggest impacts that I see are more economic, and the number one would be is that inflation is not dead. You spend too much, Fed is too forceful with interest rates and expanding its balance sheet, there are consequences to that, and we're having to deal with that with this high inflation today. After going through the previous 15 years with 0% interest rates and struggling to get to 2% inflation, to me now 2% inflation is probably the floor, whereas previously it had been more like the ceiling.
Indeed, much depends on the resiliency of the U.S. consumer. Looking into 2024, forecasts are for around 1% growth, hinging upon the labor market and the consumer. Government spending will rise during the year, creating a tailwind for growth. However, tightening loan standards, tapped COVID savings, and student loan repayments threaten to slow consumer spending. The housing market has slowed, but consumers continue to borrow on credit cards, and balances recently hit an all-time high. If growth slows, employment could decline, which would pull the U.S. economy into a recession. Though this is not our base case, the risk of a recession remains.
And the Federal Reserve, in its goal to keep inflation eventually to its 2% target, it's going to keep the Fed funds rate up relatively high until it is confident that it is on course to achieve that goal. And what that means is that overnight rates seem short, are going to be higher, as well as longer term rates. And so we're all learning to adjust to these higher rate markets. It has positives and negatives. Short-term savers get the benefit of the higher rates on the shorter end, but those that are borrowing money, it's going to cost more money.
We've talked for some time about increased global uncertainty and the resulting movement towards deglobalization. On the plus side, a less global economy would bring some jobs back to the United States. But it also may mean higher prices, less international trust, and lower earnings for companies doing global business. Deglobalization won't happen overnight. Think of it as a trend occurring over the next decade. But one thing is certain, the world today looks much different than it did 10 years ago.
The Ukraine-Russia conflict and the Israel-Hamas war, that's going to accelerate deglobalization. And why is that? Countries are going to look to resource production. Now, as they do so, that's inflationary, so the markets may be impacted by that. In addition, 15 million barrels of oil a day flow through the Strait of Hormuz from the Persian Gulf to the rest of the world. If that gets choked off or pinched, you could see a real impact in energy markets. In fact, you could see oil prices go well above $100 a barrel in that scenario.
As for capital markets in 2024, we continue to see opportunities within higher bond market yields. And as the election approaches against a backdrop of geopolitical unrest, equity markets may be facing another year of volatility. Alternatives could provide some safety as well as returns, while active management should benefit from a market that broadens from the highly concentrated equity performance of 2023.
As we look at equity markets moving into 2024, we remain slightly underweighted equities. And why is that? Earnings are at risk because of the inflation that exists in the system as well as the Fed's rate hikes over the past 18 months. In fact, if you look at history, typically rate hikes take some time to affect the economy, so earnings may be at risk. Now, multiples in the equity markets look fair, and so we're not totally bearish equities, we're just underweight at this time, and we're looking for opportunities to add.
We do acknowledge that the Fed may not be completely done with their hike cycle, but we think that they're nearing the end as rates don't have too much room to move up anymore. With that being said, we also subscribe to the higher for longer notion. We think that there won't be a cut at least until mid-2024 or later. There could be a possibility of credit spreads widening. So with that being said, it's likely that higher rated bonds or stronger credits will outperform.
Over the course of the year, we're going to continue to manage both the upside and downside market risk within diversified portfolios, as we've always done. Thank you for listening and for your continued confidence in BOK Financial.